What if I told you that you could buy a guaranteed income for your retirement at a discount? That is the big promise behind a pretty controversial product called a secondary market annuity. So the question is it a golden opportunity or is it a financial trap? Let's break it all down.
So the idea is actually pretty simple. You're essentially buying someone else's future payments, kind of like their pension, for less than what they're worth on paper. This whole thing is called a secondary market annuity, or an SMA for short. And on the surface, it sounds like a complete no-brainer, right?
And here's the main draw, the big carrot. You could potentially earn 1 to 4% more than you would if you just went out and bought a brand new annuity. Now, over the course of an entire retirement, that can add up to a serious amount of money. So yeah, it's really easy to see why these are so tempting.
Okay, so where does this discounted income actually come from? Let's pop the hood and see what you're really buying when you get one of these.
Well, to put it simply, you're not buying a new product from an insurance company. What you're really buying is someone else's used income stream. A lot of times, these come from people who maybe won the lottery or got a big lawsuit settlement, and they decide they want a big pile of cash right now instead of getting smaller payments over time.
Yeah, it's a trade-off. The original winner, they get that lump sum of cash they need today. And in exchange, you're the one who gives them that cash, and you get to collect all of their future payments. You're basically buying their patience.
So here's how this process usually goes down. It all starts with an insurance company issuing an annuity to someone. Then later on, that owner decides, hey, I'd rather have the cash now, so they find a broker to sell off those future payments. But here's the key step. A court has to officially approve this sale before you, the new buyer, can start collecting those checks.
A higher return, a court's blessing. It all sounds pretty solid, doesn't it? But with any deal that promises this much, you've got to ask yourself, what is the catch? So let's dig into some of those hidden risks. Exactly. That discount looks fantastic on the surface, but what are you really, truly sacrificing to get that slightly higher return? And here is where things get, complicated. First off, you don't actually own the insurance contract itself, just the right to get the payments. This is huge because it means if that original insurance company goes belly up, you're not protected by state guarantee funds. That's kind of like the FDIC for insurance. You're totally on your own. Second, this is a one-way street. Once you buy it, you can't sell it, you can't change it. It is completely illiquid. And finally, you're trusting a separate company just to manage your payments, which adds a whole other layer of risk. If they have problems, your checks could just stop.
And you've got to think about this too. A lot of these annuities were created when interest rates were scraping the bottom of the barrel. So even with your discount, the actual income you're buying might be way less than what a brand new annuity could give you in today's market. You might just be buying an outdated product.
So what's the alternative then? Let's compare all this to just buying a new annuity, straight from the source at an insurance company.
And here is the absolute key difference. Instead of inheriting someone else's old, rigid plan, you get to build your very own from the ground up. You are in the driver's seat, designing a contract that actually fits your life and today's economy.
The advantages are pretty clear. A new annuity is based on today's higher interest rates, which could mean a lot more income for you. You have total control to add features you care about, like protection for your spouse or a death benefit for your kids. You can even build in options for long-term care. Plus, you get way more flexibility and a direct line to the insurer. No middleman, no extra servicing risk. All right, let's do it. Let's put them head-to-head, old versus new. This is where you can really see what you gain and, more importantly, what you give up.
Just look at the difference here. With an SMA, your guarantee is just a court order. With a new annuity, it's a direct contract with the insurance carrier. Interest rates? You're stuck with old, low rates on an SMA, but you get today's higher rates with a new one. Need flexibility or access to your money? You get 0 with an SMA, but you have options with a new one. And want to leave something for your family? A new annuity lets you do that. It's a very clear trade-off between a slightly higher potential yield and, almost zero control.
So we've seen the pros and we have definitely seen the cons, which brings us all the way back to the big question. Is that extra little bit of yield really worth all of these risks?
Well, the verdict from our source material is pretty blunt. It says that for most people, the answer is probably not. The risks you have to take on are just too significant.
Look, that extra 1 to 4%, it looks great on paper. It's shiny.
But when you factor in having zero control, no way to access your money in emergency, and no real protection for your family, that discount starts to seem very, very expensive.
It really all boils down to this. Why would you buy a financial product that is fundamentally stuck in the past when you could build a modern, flexible plan that's actually designed for your future?
And that's really the question you have to ask yourself. What's more important for your retirement? Getting a small discount today or having complete control over your money tomorrow? Thanks for tuning in.